Assalamu alaikum wa rahmatullahi wa barakatuh. Brothers and sisters, today we'll discuss credit assessment. So, credit assessment is when a customer approaches an Islamic bank or a conventional bank and applies for financing, then the bank starts to do some kind of assessment. The bank evaluates the background of the customer, whether the customer is able to pay back or not. So, this chapter will be on this assessment, and we focus in this chapter mostly on the qualitative assessment, and the next chapter will be on the quantitative assessment. Okay, great. So if we overview, if we have a bird view look, if we see the cycle of a loan, if a customer goes to a Islamic bank, takes financing, and then he pays back. So if we look at this, okay, from a bird's eye view, so we can see the cycle. We can divide it into four cycles. First is the business development. Second is the credit evaluation. Third is the loan administration, and fourth is the loan recovery. Okay, so we'll discuss further on each of these level. Okay, the first is the business development. That's the initial step where the product development department, they will initiate the lending process. They will develop the product, the package. Like we have, car financing, house financing. So how will be the mood? So that's the product development department. They will initiate, and the risk management department and the Sharia department, they will work together to customize the product. They will design the financing products, and then they will also find the prospective customer. After the Sharia approval, it will go to the marketing department to market the financing product. And then the second step, when after the marketing, when any of the customers are interested, so he will approach the bank, he will apply. And then the second step will be the credit evaluation, where the bank will check the credit worthiness of the customer. So that assessment can be quantitative to see his financial oath, okay, from looking at his financial statement. And then some will be qualitative to check his status, okay, in relation to the overall economic situation, his behavior, etc. And then they will also in this also we'll see the documentation process and the validity of the documents he provided. We'll check the legal aspects of the security, means the collateral provided, how is the strength of the collateral, whether there is any legal issues, okay, if the bank wants to sell off the collateral. And then the profitability of the business. Of course, bank at the end of the day, they need profit to survive, so they will see how much profit they can get from this financing. And do not forget, the important factor is the capital adequacy. So when they give financing, it has a risk, so against that risk they need to keep some reserve. Okay, so if it is it's a risky financing, so the bank may not consider to give financing to the customer. All right. So after that is the loan administration, where if after the assessment the customer passes, if the customer pass the assessment, then the bank will offer an offer letter, and then there will be a registration of legal documentation, and then the bank will keep all the relevant documents, the ownership titles and others, and submission of other relevant letters. Means if is this there's collateral, so they sometimes need to submit some letters to the land office and so on. And so the bank will keep a record, and the customer as well. And the fourth stage is the is the loan monitoring and recovery. Okay, so the bank should not just sleep after giving the loan or financing. They need to monitor. Usually they will yearly monitor. They'll review whether the customer is paying on time or not, and if there is any changes in the terms and conditions, then the bank will issue an offer letter. And the customer as well, if there is any changes in their address or whatsoever, or in their business position, they also need to update with the bank. And then if when they are monitoring, and then if there are issues, okay, so there are some remedial management. The bank is called the remedial management, where the the bank will take action. Okay, one of them is called winding up, where the bank will liquidate the company if the bank cannot pay, if the that company cannot pay back. Okay, or maybe enforcement of guarantees. If the customer fails, so the bank will ask the guarantors to pay back. And then receivership, so this is a legal term which means if a company fails to pay back a default, so the government will appoint a receivers. Okay, means the company will be under somebody's else's supervision, and he will decide whether to liquidate the sale of some assets to pay back. Okay, foreclosure is the closure of the business. Okay, turnaround service is a service is where a company is struggling, okay, to pay back the loan, but they have a good intention, but they, because of some business problem, they are struggling to pay back. So in that case, the financial institution, together with, let's say, some other institution like credit counseling department, okay, they can give some kind of service to the company owners or the management, that they can suggest that you can either sell off some of your asset, or you can reduce your cost, or you can reduce your clients, etc. So this is a service to suggest the company, so that they can cover their loss and then able to pay back the loan. Okay, so in the loan monitoring, okay, when they do yearly review, so they will divide the loans or financing into five types. Okay, one is the current. Current means everything is fine, the customer is punctual to pay back. Okay, and the second one, especially mentioned, is the customer is paying back, but he sometimes need reminders. He paying late. One month he's paying on time, another month he's late. So that one is called specially mentioned. Another one is a substandard, where the customer failed to pay back 1 month or maybe 2 months, but is still he is paying back. There is a hope that he will pay back. And after that is the doubtful. Doubtful is the customer is defaulted. He is not able to pay back for more than 2 or 3 months, or even more, but still there is a little bit hope that he may come back. Okay, he may. And the final one is the loss, where there is no hope to get back the financing. Okay, so for the banks, if it for these categories, the bank needs to restructure the loan. The bank will call the customer, will discuss with the customer whether bank can help in any way. Okay, maybe for especially mentioned customers just needs a reminder, okay, to be punctual. For substandard, maybe the bank can give some kind of assistance to restructure, so that the business can come back. Okay. Now, so what are the principles of good lending? How, okay, from the bank's perspective, okay, how we can say that this financing is a good financing when we evaluate the performance of the bank or the performance of the credit officer. When we can say is this bank is performing well in terms of providing credit or financing. The first criteria is that it reflects the national policy. Okay, the government has a national policy that we need to help the B40, for example, the marginal groups. Okay, so if the financing is helping that kind of people, so it is a good financing. Okay, and then beneficial purpose to the client. Okay, and it is also in line with the Sharia. Okay, we should not assist someone to do something bad. Okay, so if financing a loan is given to a beneficial purpose, to do business, for example, to buy car or house, which is beneficial, so it is good. But if it is to do something wrong, okay, to buy okay, weapons, for example, okay, or for some kind of personal financing, okay, which is not beneficial, yeah, is okay, is not to make a to buy casino, for example, it is not allowed. And then well diversified client base means when a financial institution is giving customers to different backgrounds, it has a customers who are lawyers, who are government employees, who are businessmen, so that is good. Okay, and it is short term. Of course, short term is less risky, when long term is it has higher risk, and also there is inflation, so that's we need to taken into account. Following the basic risk and return policy, the basic risk and return policy is that higher risk, higher return. If bank gives okay, financing to a high risky customer, bank also should charge higher profit. If low risk, then lower profit. So if the bank is following this, so this is a good lending. So usually we see if the government employees, the profit rate charge is lower than somebody is self-employed, because the self-employed person got higher risk. Okay, and then self-defined repayments, sorry, well-defined repayment sources. Okay, a good lending where the person has a stable income, okay, regular stable income, and very strong okay, source of income. So for example, is that if you're a government employee, so it is quite stable. Okay, if somebody has a very stable business, and the business has a stable income, so that is a good lending. All right. So we move on to general qualitative assessment tools when we do assessment. So what is the very basic or fundamental principles of assessment? Okay, so here comes the 6 C's of credit. Okay, so there are a lot of methods used by different banks. They have softwares developed. Okay, many criterias are there, but all those criteria, they come back to these 6 fundamental factors when they do the assessment. The first is the character. What is character? Character is the attitude of the person, where it is the most important thing, means that whether the customer has a right attitude to pay back. Okay, there are many rich people there, but there are many of them among them that they do not have the attitude to pay back. Okay, and it is in line with the Sharia as well. If we want to borrow, we must have the attitude to pay back. Okay, so this is the character. So character is our character, our attitude, whether we have the right attitude to pay back or not. So how we know that? We know from the history. So we can see his previous financing, whether he paid back okay, or maybe his other kind of financial commitment, or any of his, whether in his okay, whether he breached any kind of financial commitment or not. And the second is the capacity. Capacity comes second. Okay, capacity is whether the person really has the capacity, he is financially capable of paying back the financing. Somebody cannot, bank cannot just give money if the customer cannot uh, pay back. He So how we know the capacity? We'll know through his salary, or he has a business which has stable income, or if he has a rental income, or if he has an income from any other sources. So that the way we know his capacity. So here we know his financial oath, his income. And the third is the capital. Capital, what is capital? So does the borrower have enough cash on hand to pay if a period of adversity arises? So means that whether the person has any second source of income or any support if there is, if he lost his job. Okay, so that is his capital. So here we can see the his maybe his household income, whether his wife has a job, or whether he has, saving account, or whether he has any kind of investment where he can take when he lose his job, or he lose his income, or his business, he lose profit in his business, okay, due to some adverse situation. And then the fourth is the condition. Condition is that we will measure the person in relation to the total economic environment. Whether is there anything from the broad perspective, from the broad economic perspective, will anything affect his business? Whether the person's business, whether the area is a flood-prone area, whether his business is subject to any economic situation like right now COVID, whether the business is affected by COVID, for example. So that is the condition. Okay, and the fifth is the collateral. Collateral is the security, the pledge. Okay, means a backup. If the bank cannot, if the customer fails to pay back, does the bank have anything, an asset or anything that the bank can sell off to get back the collateral? Will the credit issuer be protected if the borrower fails to repay the loan? So is there any guarantee or any security for that? And the mm, final one is the common sense. Okay, the common sense will tell us, okay, whether the person has good character, or he is prudent in handling his financial affairs. Okay, so if a person, his salary is 5,000 and he just bought a Mercedes, so we cannot say he has a good common sense in handling his financial affairs. So we can know this through his history, and also through his behavior, through interviews with him. Okay. So these are the six characters. So I want all of my students to understand these six concepts by heart. Okay. So these are the basics of the credit assessment. So there are many softwares or criteria used by different banks, but all those come back to these six C's. But other than six C's, there are different models developed. One of them is called company model. So this one has one, two, three, four, five, six, seven criteria. So they are quite similar with the six C's, like character, ability to repay is similar to the capacity. Okay, but there's some new, like margin of finance. So it means how much the bank will give financing. Okay, if the customer asks for 100,000 for financing, the bank may not approve it. Okay, so this because bank will see his capacity, whether the person has the capacity, and also the risk factors. So this is the margin of financing, is where bank will see how much the customer can afford. Another thing is purpose, is very important, especially for business financing. When the businessman wants to borrow, we want to see what is his purpose. If he wants to extend his business, that is good. But if he wants to borrow to pay the salary for his employees, so there is a red sign there. Okay, means he is not getting profit from his business. Okay, this is the amount, is the how much amount will be disbursed. Okay, the repayment terms, it means okay, the how the person will pay back for how many years. Okay, how with how many installments. Okay, and insurance is similar to the collateral, but insurance a bit more. Okay, insurance where it will cover if the person passes away, then insurance company will pay back. Okay, so the default function, or the most important criteria based on different models, is first is the net worth. Okay, how much the person owns, how much money he has. Okay, and the stability of earnings, how stable is his earning. If he's doing business, how stable how regular the profit in his business. If his job, how stable is his job. If somebody in a job with the experience, so that is more stable than a person who just newly entered joined his job, okay, and the quality of the information. The finance, it is common, even though we are Muslim, there are people, they tipu, they lie, okay, they fabricate their financial statements. So the financial institutions we need to see the quality of the information provided. Okay, so now we'll talk about, so just now what we have discussed is applies to both consumer financing and business financing, means retail customers and also businesses. Okay, so now we will assess the quality of business. Okay, so when as you know that if you go to any bank, Islamic bank, and if for you ask for your home and car financing, it will take sometime 1 day or sometime even few minutes, okay, to get your loan approval. But if you apply for a business financing, it will take up to 3 months, okay, at or minimum I think 1 month, or at least 2 or 3 weeks. And most of the branches they will refer to the head HQ, the headquarter for business financing, because business financing is quite complicated. So as a credit officer, okay, or as a future credit officer, you need to know different types of business. Of course, you will develop this throughout your life with your experience, but you need to have a basic understanding of all these businesses. Okay, so if we evaluate any business, what we see first, okay, we see the strength of shareholders and management team. How strong are the shareholders? Who are holding who are the major shareholders? Even when we do investment in certain companies, we also see who are the shareholders. We see, wow, this public mutual or big companies or the government is the shareholder of this company. It means this is stable. And the management team, okay, whether those who are in the management team, they have enough experience, whether okay, they are, means there is a healthy relationship among the management. Okay, if there is a political issues, if there are clash among the management, so those are risky companies. They cannot get financing most of the time. And then change in accounting policies. If the business, they always keep changing their accounting policies, they change their account auditors, so there is a red sign there, means there are some issues in their in their financial statements. And level of government support or intervention. If the government changes, okay, the support to certain businesses, so we need to it's our concern, because if the government changes the rules or regulation, okay, supporting certain companies, so it is good that those companies will last long. We need to see the life cycle of the industry. Okay, certain industry, they are booming. For example, Mr. DIY, they are growing to eco shop, e-wallet, these are booming. And some industry, they are just going to die. For example, the printing industry, the photocopy industry, okay, Kodak, or the camera. Okay, so we need to see the industry, the life cycle, okay, at what cycle the industry is. And then environment of the competition. Okay, so now there are huge competition. Okay, for example, there are certain businesses, there are huge competition, like we can say like smartphone business. So smartphone is a huge competition. Okay, every day they need to come out with the new products. There is a huge competition there. However, there are some where there's not much competition. Okay, that's they are the only one, or there are only 2 3 providers of this, so that is a good business. For example, we have for computer processors. Okay, but right now it is competitive as well. Okay, for we have Android, we have Intel, and then we have AMD. Okay, so there is a competition, and we have Microsoft and Google. There is a competition, but for many years Microsoft is the only one, or Intel was the only one in this market. So we need to see the pattern of the competition in the market. Uh, And then the shopping online business, okay, like the Shopee, we have Amazon. Okay, so Amazon is a run ahead of the competition, so they are very good companies. And then the over concentration of purchasing policy of, so if a company is, purchasing too much of raw materials or new things, so that's actually dangerous, that is risky for the banks to give financing. And see, I think most of you are familiar with this. So most of the businesses, they have a life cycle. They start, they grow, they reach to maturity, then they decline. So we need to understand when the business has applied for a loan, at what point they are. Are they here? So don't be deceived. The quantitative assessment cannot find this, but the qualitative assessment, we must know. If the business is here, means they are in good position, but they are going to decline. Okay, so maybe I can say like Microsoft, they are maybe is matured, but they are going to maybe going to decline. Or even you can say some computers like Dell, for example, they are also going to decline, or HP. While the others like Lenovo, for example, they are growing. The Chinese companies, or SR, they are growing. So a good credit officer who knows the business very well, knows well, okay, the company. So and then we also need to see very different characteristics. Okay, we need to assess the risk of the business based on certain factors like cost structure. How is the cost structure? Whether this type of business require a lot of costs, okay, raw material, like construction companies, their cost structure is very high. They need to spend a lot, okay, which is different from like e-wallet and technology companies, where they don't have to spend much for their business. And then the maturity, how matured is it? A new business, or it is quite matured, okay, or it is already matured and going to decline. So we need to see that, okay. And also cyclicality, some of the businesses, they have a cycle that like they are seasonal, like a tourism business, a hotel business, or airlines business. So they have a cycle, okay. There is a season for tourism like June, July, or like December, school holidays. So the business related to tourism, hotel business, they have a cycle. So we need to understand that how vulnerable to seasonal up and down. And the profitability, what kind, how is the profit? Okay, the good profit is which is small profit but regular. Okay, but if huge profit but not regular, that is dangerous. Okay, so if the company has a regular profit, that is sustainable. But if a computer has a very high profit and very low, so the volatility is very big, so it is risky. And the dependence, okay, on what they are depend, okay, maybe this company is dependent on others. You can see many like Nokia. Okay, one of the reason for they went bank, of course they have many reason. Main is they didn't update their product. One of them, their dependence. Okay, like IBM. Have you heard of IBM? It was one of the famous computer brand, but they now went out of market because they outsource everything. Okay, they started to outsource. So when they depend then too much on others, so others gradually will take their business. And then substitutes, whether this business has any alternative substitutes or not, or they are the only one, okay, or two. Okay, so uh, for example, now Android is something, maybe there's no there are very few substitutes for that. Okay, we can say that. Okay, or some business like the telecom providers. Okay, there is only one telecom providers. Okay, or there are and then you can see the construction companies are from China. Okay, so there are not much construction companies, okay, in different parts, because they are the Chinese construction companies, they can do fast and with the low cost. Okay, so maybe they are difficult to find any substitute for that. or even some kind of products we cannot get any alternative of that. That's the only one in the market. Like for computers, Windows and Apple, they have been the dominating the market for laptops. So there are very few substitutes, but now Android is going to take over. Okay, so these are the factors, and then we also need to see the businesses from the industry perspective. Different industry got different risk profiles. Okay, for example, uh, trading companies, they are like, we can say, the grocery shops, or we can say like Kedai Runcit, or we can say the hardware shops, or even Mr. DIY. So all these are trading companies that they buy products and then they sell. So this type of industry, they have certain type of risk that other companies they don't have. One of them is like weak on first party collateral, because these kind of small businesses, they do not have big buildings, or they may not have huge assets, so they may be weak to provide any collateral. Rather, maybe the owner's house they can offer as collateral. And they also face the products and market risk. Okay, if the price of the commodity goes down, okay, you see the all the small businesses right now, they are affected of COVID because of the market risk. Okay, the price went down, and also the economic risk, the situation, there is a slowdown in business overall. And then they also face forex risk. If the ringgit, for example, when the ringgit Malaysia goes down, so these companies, most of them, they bring their goods from, let's say, from China, so they have to pay more money, okay, spend more to buy their goods. And then they have liquidity risk, because these companies, they get profit immediately, they spend for their household expenditure, so they usually don't have much cash. And then capital risk due to weak reserve. Okay, so as they do not have a lot of reserve, they just get profit and spend, so of course they don't have a huge capital. And then how about the manufacturing companies, okay, that manufacture products like top globes, okay, or any kind of companies that produce like food stuff, okay, or cosmetic materials. So they have also many risks, okay, or even the car manufacturing companies. First is the raw material supply risk. Okay, if there is a problem in the raw material supply, for example, Proton, they bring their raw material from Japan. So if there is any political issue, or there is earthquake in Japan, so there is an earthquake in Proton as well, because it might affect the raw material supply. And then product risk, okay, whether the product manufactured end product, whether whether they can sell it to the customer or not. The market risk, whether they can survive in the market with the competition. And then forex risk, okay, if the raw materials are from overseas, okay, if the currency, okay, exchange rate changes, so they will be affected. Technology risk, okay, so we are in the era of technology. The manufacturing companies, they need to use technology to reduce the cost. Okay, so many companies, they are now using technology. They can reduce the cost, so they can sell the product cheap. And they can make it fast. So if the companies, if they use a technology which is not suitable, if they do not adopt the technologies, so they may fail. Okay, uh, and then costs, or like, we can say like in Malaysia, uh, Malaysia, they produce palm oil. Okay, but they don't have technology, or the companies do not use the technology to produce other products from the oil, for example butter or whatsoever. Okay, so that's I would say a risk for this oil producing, or companies. Okay, the cost overrun risk. This is a very important risk for the manufacturing companies. Okay, if their cost overruns. Okay, if they estimate, okay, suddenly the raw price of the raw material or the price of the human resource, okay, changes, okay, then it will, the cost will overrun. The contractor risk, sometimes the manufacturing companies, they give subcontracts, okay, like Perodua, not it's a Perodua car, not everything they make, okay. So for example, for coloring, for example, they give to other contracts for contractors. So if that contractor failed to fulfill his commitment, so then it will be risky. Fire risk, okay, manufacturing companies, they are prone to fire. And then management risk, okay, if the top management of the company, they are not efficient, they are not skillful, if they do not have healthy relationships, so it is also risky. And then contracting companies, so these are the companies who take contracts, usually for house contractors. They are not the one who produce the house, but they take contract and they give to others. Okay, they are kind of like agencies. So their risk is performance, whether they will be able to fulfill. And these companies, they do not have much cash, so they also have liquidity problem. And their main risk is over trading. If they take too many of contracts, so there is a risk that they may not be able to perform or fulfill some of their contracts. And then housing developing companies, I think many of you have experienced. There in Malaysia, many housing development project abandoned, okay, it failed, okay. So there are different types of risks. One is the demand risk, when the house is built, whether there is a demand or not. Okay, I read articles in I think in last there in KL, there are many okay, flat are not sold. You see, last few years, okay, the government ceiling for the foreigners to buy a house is 1 million, but they reduced to 600,000 because the local were not able to buy. Okay, so the government was forced to reduce the ceiling because the demand went down. And then the completion risk, whether the developer will be able to complete on time. Okay, so it depends on the, you see, the COVID-19 stop the, okay, force the workers to stop. And then the cost overrun, if the price of the materials or the price of labor went up, so they will also face cost overrun. And then there are also legal issues, because this construction company, they need legal clearance as well. Okay, so these are the examples of the risk associated to different companies. Okay, so these are subjectives, and this kind of risk assessment, it is not easy. Okay, so and there is no right and wrong in some cases, because they are subjective. So this kind of assessment is done by the HQ of the bank most of the time, because it needs a very experienced credit officer, okay, or group of credit officers who are well versed in business. They know the business risk, the overall situation. So these are the things cannot be done by the software. It needs a kind of deliberation. So what I would suggest, that what the new credit officers need to know is that they need to have a good exposure to different kind of businesses, and they need to be updated with the latest. Okay, how many of us, we always read the latest business news, okay, so that we can know what type of businesses are performing, what type of businesses are going down. So this will actually help us. And this assessment also sometimes related to your investment in shares, stocks. Okay, we want to know which companies are growing, which are, going down. Okay, so, and also what are the issues, like we have recently, the top globes are restricted in US because they have exploited the labor. Okay, they force. So this is an issue that made many to okay, those who bought the share of Top Glove, they lost. Okay, so this the key criteria here is our experience, and we need to be always updated with the industry. So today we already discussed what is the fundamental criteria of assessment, and then how to assess the different types of business, what are the factors to assess a business financing. So that's all. Thank you. Assalamu alaikum wa rahmatullahi wa barakatuh.